Well, we make bad investment decisions plenty of times, but I can't recall in the history of Berkshire we made an emotional decision. Have we ever made an emotional decision?
No.
Oh, yeah.
At Berkshire Hathaway's 2023 annual meeting, Warren Buffett warned that emotional decision-making is the one fatal flaw that destroys investment returns. Now in 2025, global markets have experienced their largest crash since 2020, with widespread panic selling triggered by emotional reactions, proving Buffett was right that emotional decisions remain investors' biggest enemy. Millions of investors have watched emotional trading cause them massive portfolio losses during 2025's market turmoil, while disciplined investors who stayed the course recovered quickly. What seemed like basic wisdom in 2021 has become the difference between financial survival and devastation. As a CEO of Berkshire Hathaway managing over $1 trillion in assets, Buffett has delivered 20% annual returns for nearly 6 decades, making him arguably history's most successful investor. If Buffett was this accurate about the emotional trading disasters we witnessed, his insights about the investor psychology are absolutely essential. You need to hear what he said.
Mr. Buffett, Mr. Munger, it seems like you found the sweet spot between being too conservative and too aggressive as investors. Do you ever make bad investment decisions because of your emotions, and what do you do to try to keep that from happening?
Well, we make bad investment decisions plenty of times. I make more than Charlie because I like to think it's because I make more decisions, but probably my batting average is worse. But I can't recall in the history of Berkshire we made an emotional decision. Have we ever made an emotional decision?
No.
Oh, yeah. That's in business we're talking about. Yeah. Now, you don't want to be a no-emotion person in all of your life, but you definitely want to be a no-emotion person in making an investment or business decision.
Before we can appreciate Buffett's claim about never making emotional decisions, we need to understand the battle between emotional and rational thinking in investing, because this internal conflict is what separates successful long-term investors from those who buy high and sell low. Think about the last time you were really angry at someone. In that moment, did you make your best decisions? Probably not. That's your emotional brain taking over, and it's terrible at making good long-term choices. Now imagine you're watching your investment account during a market crash. Your portfolio is down 30% in a week. Every instinct is screaming, sell everything before it gets worse. That's the exact same emotional brain that made you say regrettable things when you were angry. This is the difference between emotional and rational decision-making. Your emotional brain is designed for immediate survival. It's fast, it's reactive, and it's focused on avoiding pain right now. Your rational brain is slower, but much better at thinking through consequences. In investing, these two systems are constantly at war. When markets are soaring, your emotional brain screams, buy more. When markets crash, it yells, sell everything. But successful investing requires you to do the opposite of what feels natural. Buy when everybody is panicking and sell when everybody is euphoric. The most successful investors have learned to recognize when their emotions are trying to make decisions and have systems in place to override them. They use rules and predetermined strategies that remove emotional element entirely. It's not about being cold, it's about understanding that emotions are helpful in relationships but destructive in investing. Understanding this difference is crucial if you want to become a successful investor, but Buffett reveals that there's actually a profitable side to other people's emotional mistakes. However, what he shares next about how irrational behavior has dramatically increased will show you exactly how to turn other investors' dumb decisions into your advantage. This insight he's about to reveal could change completely how you view market opportunities. Let's hear what he has to say.
What gives you opportunities is other people doing dumb things. And it's not, and I would say that, well, the 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things, and they do big dumb things, and the reason they do it to some extent is because they they can get money from other people so much easier than when we started. So you could start 10 or 15 dumb insurance companies in the last 10 years, and you could become rich if you were adroit at it, whether the business succeeded or not, and the underwriters got paid, and the lawyers got paid. And that creates, if that's done on a large scale, which it couldn't be done, 58 years ago, you couldn't get the money to do some of the dumb things that we wanted to do, fortunately. So I think that investing has disappeared so much from this huge capitalistic market that anybody can play in, but that the big money is in selling other people ideas. It isn't outperforming. And I think if you don't run too much money, which we do, but if you're running small amounts of money, I think the opportunities will be greater. But then Charlie and I have always differed on this subject. He likes to tell me how gloomy the world is, and I like to tell him we'll find something. And so far we've both been kind of right. Charlie, wouldn't you? Will you budge an inch on that or not?
There is so much money now in the hands of so many smart people, all trying to outsmart one another and outpromote one another, getting more money out of other people. And it's a radically different world from the world we started in. And I suppose it will have its opportunities, but it's also going to have some unpleasant episodes.
But they're trying to outsmart each other in arenas that you don't have to play. I mean, if you look at that government bond market, if you at the Treasury bill market, I mean, you've got this one bill that's out of line with the others. We bought over $3 billion of it the other day, but those are people. The world is overwhelmingly short-term focused, and if you go to an investor relations call, they're all trying to figure out how to fill out a sheet to show the earnings for the year, and the management is interested in feeding them expectations that will slightly be beaten. I mean, that is a world that's made to order for anybody that's trying to think about what you do that should work over 5 or 10 or 20 years. And I just think that I would love to be born today and go out with not too much money and hopefully turn it into a lot of money. And Charlie would too, actually. He just he would find something to do, I will just guarantee you. And it wouldn't be exactly the same as before, but he would have a big pile.
I would not like the thrill of losing my big pile into a small pile. Well, we like my big pile just the way it is.
Well, we agree on that, incidentally. Okay.
Yeah, we do. You're one of the most extreme lovers of the big pile.
To understand why Buffett sees massive opportunities while others see an overcrowded market, we need to understand the difference between short-term and long-term investment thinking, and how the modern obsession with quarterly earnings and instant profits has created a world where patient investors can build fortunes simply by ignoring the noise everyone else is drowning in. Short-term investors are obsessed with what happens this quarter, this month, or even this week. They're constantly checking stock prices, reacting to every piece of news, trying to guess what earnings will be next quarter. They jump in and out of stocks based on momentum, rumors, or whatever's trending. It's exhausting, and most importantly, it doesn't work. Long-term investors think completely differently. They ask, what will this company look like in 5 or 10 years? They buy businesses they understand and hold them through the ups and downs. They're not trying to time the market or outsmart everyone else. They're letting time and compound growth do the heavy lifting. Here's what makes this powerful. When everyone else is focused on tomorrow's stock price, they miss the bigger picture. Think about Amazon in 2008. The stock dropped 50% during the financial crisis. Short-term investors panicked and sold. But if you were thinking long-term, You saw a company building the future of shopping. That same investment would be worth 40 times more today. The irony is that more people focus on the short term, trying to outsmart each other day by day, the more opportunities they create for patient, long-term thinkers. While everyone is fighting for quick profits, long-term investors are quietly accumulating wealth. The modern market has become so short-term focused that simply being patient has become a competitive advantage. Understanding this difference between short-term and long-term thinking is crucial if you want to become a successful investor. But Buffett reveals there's another powerful advantage that separates Berkshire from almost every other company on Wall Street. This advantage has allowed them to build one of the greatest fortunes in history, yet most investors completely overlook it because they're trapped in a system designed to work against them. Let's hear what he has to say.
We feel no pressure from Wall Street. We don't have investor calls. We don't have to make promises. We get a chance to make our own mistakes and occasionally find something that works well. But we recognize that the people in this room and people like them are the ones that we're working for, and we're not working for a bunch of people that care about whether we meet the quarter estimate or anything. So we have a freedom that we get to use, and we're interested in owning a wonderful business forever. Well, there aren't very many wonderful businesses. We just keep learning as to more about how people behave and how a good business can turn into a bad business, and how some good businesses can maintain their competitive advantage over time. So we don't have some formula. Berkshire people, but we can also tell in 10 seconds whether it's something of interest. I mean, when I get these calls and we want to send decks and all that sort of thing, which is nonsense. I mean, it's a bunch of guys sitting that get paid for drawing up these projections of the future and everything like that. If they knew the future, we don't know the future, but we do know certain kinds of businesses. We know what the right price is, and we know what we think we can project out in terms of consumer behavior and consumer threats to a business, and that's what we've been about, and that's what we'll continue to be about. We don't get smarter over time. We get a little wiser, though.
To understand why Buffett ignores Wall Street's demands and makes his own long-term bets, we need to understand what a competitive advantage really is. Because a company's real value isn't what it earns this quarter, is whether it can keep earning money year after year. Imagine you own a coffee shop on a busy street corner. At first, you're the only coffee shop around, so customers come to you by default. But then a chain of coffee shops opens across the street. Suddenly, you have to compete. Now, here's the key. Some businesses have what we call a competitive advantage. Something special that keeps customers coming back even when competitors show up. Maybe your coffee is genuinely better. Maybe customers love your friendly staff. Maybe you build such a strong relationships that people prefer you out of loyalty. That's real competitive advantage, something a competitor can't easily copy. But here's what's tricky. That advantage doesn't last forever. A bigger chain might hire better baristas. They might spend millions on marketing. They might offer loyalty programs you can't afford. Over time, your advantage starts to weaken. What once made you special now becomes just ordinary. This happens to big companies too. Kodak invented digital photography but stuck with film. Netflix changed how we watch movies, but now every studio is creating their own streaming service. Their advantage eroded. Some businesses, though, they managed to keep the advantage. Think about Coca-Cola. They dominated for over a century. Why? Because their brand is so strong, their distribution is so vast, and their recipe is so iconic that competitors can't knock them out of top. Here's why this matters. A great business isn't just the one that makes money today. It's one that can keep making money tomorrow. And the best investors, they're the ones trying to figure out which businesses will maintain their advantage and which ones won't. want. Knowing how to spot a competitive advantage is the foundation of smart investing, but Buffett takes this concept further by showing us exactly how to apply it in the real world. The difference between understanding the theory and actually deploying it can mean the difference between missing opportunities and building real wealth. What he reveals next is a perfect case study of this principle in action, a real investment decision that demonstrates his philosophy in practice, and it might surprise you just how simple his actual decision-making process really is when you strip away all the noise. Let's hear what he has to say.
Well, the Japanese thing was simple. I mean, I like looking at companies. I like looking at figures about companies, and here were 5 very, very substantial companies, understandable companies. Most of them, maybe all of them, we'd done business with in a dozen different ways. If you go a couple miles from where this place is, our last coal generating plant was built by one of the companies. So here they were sitting as a group where they were earning, we'll say 14% on what we were going to pay to buy them. They were paying decent dividends. They were going to repurchase shares in some cases. They owned a whole bunch of businesses that we could understand as a group, although we didn't mean we had deep understanding on any of them, but we seen them operate and everything. There wasn't anything to it. And at the same time, we could take out the currency risk by financing in yen, and that was going to cost us a half of 1%. Well, if you get 14% on one side, a half a percent on the other side, and you've got money that, forever, and they're doing intelligent things, and they're sizable. So we just started buying them. I didn't even probably tell Greg until maybe 6 months after we'd gotten going, and then when we hit 5% in all of them, we announced on my birthday and at 90th that we owned over 5%, and recently went over for the first time to visit with them, and we were more than pleasantly surprised, delighted with what we find there. And now we own 7.4% of it. We won't go over 9.9 without their agreeing, and we sold another 164, whatever it is, billion of yen.
Would have done for us if we only had $5 billion or something, and it made $10 billion simply in that way.
Yeah.
We would look like heroes.
To grasp why Buffett could confidently invest billions in Japanese companies while earning 14% returns, we need to understand the currency hedging and risk-adjusted returns, because this strategy unlocks an entire world of investment opportunities that most people ignore due to currency fears. Imagine you're planning a vacation to Europe next year. You book a hotel that costs €1,000, and today that equals $1,000. But what if the dollar weakens over the next year? When you actually pay for the hotel, those €1,000 might cost you $1,200. That extra $200 loss has nothing to do with the hotel, it's just currency risk. Now imagine you could buy a simple insurance policy that locks in today's exchange rate for just $5. No matter what happens to the currency values, you'll pay exactly $1,000 for that hotel. That's essentially what currency hedging does for investments. When Buffett invested in Japanese companies, he faced the same problem. He found great companies selling for cheap prices, but he was buying them with yen. If the yen weakened against the dollar, he could lose money even if Japanese companies performed perfectly. Here's the brilliant part. Buffett eliminated this risk by borrowing yen to buy stocks. Think of it like this. If he owns Japanese stocks worth 1,000 yen and he owes a bank 1,000 yen, then currency movements cancel each other out. If the yen falls, his stocks are worth fewer dollars, but his debt is also cheaper to repay in dollars. The cost of this protection was tiny, just 0.5% a year, so Buffett was earning 14% from owning excellent Japanese businesses, and it only cost him 0.5% to eliminate all currency risk. That gave him 13.5% return with much less risk than if he let himself expose to the currency swings. Most investors avoid foreign stocks because currency movements seem scary and unpredictable. But Buffett showed that you can have your cake and eat it too. Invest in the great companies anywhere in the world while removing the currency risk that scares everyone else away. Understanding currency hedging is crucial if you want to access global investment opportunities, and this strategy helped Buffett make billions from his Japanese investments. However, his next insight will completely challenge everything you've been taught about diversification. What he reveals about putting huge amounts of money into single positions goes against every finance textbook ever written. Let's hear what he has to say.
The next question comes from Eli Amin Tibet, who asks, during an episode of Investing the Templeton Way podcast, Professor Damodaran, who he respects almost as much as Warren and Charlie, mentioned that he is not comfortable with positions becoming a large part of his portfolio, for example, when they reach 25 to 35%. He mentioned that Apple is now 35% of Berkshire's portfolio and thinks that that is near a danger zone. Wonders if Warren and Charlie can comment.
I'd like to make one comment first, but Charlie will come up with.
I think he's out of his mind.
Yeah, I knew that was coming. But Apple is not 35% of Berkshire's portfolio. Berkshire's portfolio includes the railroad, the energy business, Garanimals, you name it, See's Candy. They're all businesses. And, the good thing about Apple is that we can go up. They buy in their stock, and instead of owning 5.6%, they got about 15 billion, 700 and some million shares outstanding. They get down to 15.25 billion without us doing anything. We got 6%. So we can't own more than 100% of the BNSF. We can't own more than 100% of Garanimals or See's Candy. And it'd be nice. We'd love to own 200%, but that just isn't doable. But they're all the same. They're good businesses. And to think that our criteria for Apple is different than the other businesses we own. It just happens to be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad. And Apple is a better business. Our railroad is a very good business, but it's not remotely as good as Apple's business. Apple has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own 100% of, but we're very, very, very happy to have 5.6 or whatever it may be percent, and we're delighted every 0.1% that goes up. That's like adding $100 million to our earnings. I mean, our share of the earnings, and they use the earnings to buy out our partners, which we're glad to see them sell out too. The index funds have to sell if they bring the number of shares down. And, we went up slightly last year, and I made a mistake a couple of years ago when I sold some shares when I had certain reasons why gains were useful to take that year from a tax standpoint. But having heard me say that, it was a dumb decision. Charlie, you've already given your comment about it, but we do not have 35% of Berkshire's portfolio. Berkshire's portfolio is the funds we have to work with. And we want to own good businesses, and we also want to have plenty of liquidity. And beyond that, the sky's the limit, or our mistakes, who knows what the bottom is. Charlie, do you want to add anything to your earlier comment?
Well, I think one of the inane things that's taught in modern university education is that a vast diversification is absolutely mandatory in investing in common stocks. That is an insane idea. it's not that easy to have a vast plethora of good opportunities that are easily identified. And if you've only got 3, I'd rather be in my best ideas instead of my worst. And now, some people can't tell their best ideas from their worst, and in the act of deciding that an investment already is good, they get to thinking it's better than it is. I think we make fewer mistakes like that than other people, and that is a blessing to us. We're not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. And a lot of people who are geniuses on IQ tests think they're a lot smarter than they are, and what they are is dangerous. But if you know the edge of your own ability pretty well, you should ignore most of the notions of our experts about what I call diversification of portfolios.
Okay.
To grasp why Buffett and Munger reject conventional wisdom about portfolio diversification, we need to understand concentration versus diversification strategies and how following traditional academic advice can actually increase your risk while limiting your potential returns. These are 2 completely opposite philosophies about how to invest your money safely. Most financial advisors and business schools teach diversification, spreading your money across as many different investments as possible. If you have $10,000 to invest, you might put $200 into 50 different stocks. The theory is that if one company fails, the other 49 will protect you. Concentration is the opposite strategy, putting larger amounts into fewer investments you understand exceptionally well. Instead of owning tiny pieces of 50 companies, you might put $2,000 each into your 5 best ideas. But here's where Buffett and Munger challenge everything you've been taught. They argue that diversification can actually be more dangerous. If you're forced to own 50 different stocks just to be diversified, you'll inevitably buy mediocre companies you don't understand. Munger calls this diversification, making your portfolio worse by diluting your best ideas with inferior investments. Their logic is simple. If you can identify truly exceptional businesses, why limit your returns by also owning average ones? The key is knowing the difference between your best and worst ideas, something most people can't do reliably, which is exactly why diversification exists as a safety net. This philosophy perfectly captures everything we learned today from Warren Buffett. Whether it's making decisions without emotions, profiting from others' irrational behavior, using currency hedging to unlock global opportunities, or concentrating your best ideas rather than diversifying them into mediocrity, Buffett's approach consistently goes against conventional wisdom. With nearly 60 years of experience running Berkshire Hathaway and delivering 20% annual returns while building a $1 trillion empire, Buffett has proven that patient, rational thinking beats following the crowd. The insights you learn today can help you avoid the emotional traps and conventional mistakes that destroy most investors' returns, setting you on a path toward building real, lasting wealth.